association more easily between Ronaldo and SIU than it does between Albuquerque and SIU. And I checked, it does. Apparently Ronaldo does a kind of a jumping spin after he scores a goal and screams out, "See you." I'm not a fan of football, so I didn't know that before. But might I suggest that Ronaldo is a lot easier to spell than Albuquerque, and that maybe the misplaced association is more a reflection of the state of the spelling skills of American AI. And dare I... Yeah, the King Charles speech, I think, rubbed off on me. So how does one introduce the person who needs no introduction? European AI does make the association between SIU and Luís Albuquerque no problem. So for spelling queries, we now know which AI to use. Commissioner Albuquerque will now deliver her keynote speech, and she told me earlier that her favorite part of a speaking appearance is the Q&A part, and I think you already have a question lined up, and I would recommend to colleagues in the audience that you think about your questions in advance. I've seen her in action doing Q&A. She's good, and we look forward now to the keynote speech. Thank you.
Thank you very much, John. And I'm really happy to hear about the association between SIU and Ronaldo, because I mean, talk about an audience and the outreach. I have to try and ask him to support the SIU. Okay, so good afternoon, ladies and gentlemen. It is a pleasure to be here among elected officials, esteemed colleagues from the European Central Bank, other EU and national authorities, academia, thought leaders, and partners from industry and civil society. Bringing together such a broad range of perspectives is essential to informed policymaking. This diversity is what allows us to get it right. And perhaps more than in the past, I sense that we are increasingly aligned on the direction of travel. It's unlikely that I am the first to bring it up today, even if it wasn't that too visible in the last panel, but the geopolitical context matters here. Over-reliance on others has left us exposed to shocks, especially in the current context where predictability is diminishing. We have witnessed this clearly in recent years. Energy price shocks have fed directly into household budgets, and the euro area's macroeconomic outlook has been adjusted, bringing with it renewed concerns about stagflationary dynamics. We must recognize that the current geoeconomic context is our new normal and ensure that our economy provides protection from shocks outside of our control. A stronger and more integrated single market, truly one market, including a stronger European financial sector, can build our economic defenses, including to shocks like the one we are currently experiencing. Of course, there are entrenched views in the debate on more financial integration, already referred to here as well. We all know this well, and they have held us back for years. But increasingly, the bigger picture and the importance of a well-functioning single market is becoming impossible to ignore. Since March last year, we have been working to turn the SIU from words into action. We have published plans for financial literacy and the blueprint for savings and investments accounts, recommendations and legislative proposals on supplementary pensions, all of this aimed at getting citizens involved in capital markets and giving them more opportunities and incentives to save and invest. We have put forward measures to boost the availability of equity financing, including for pension funds and insurers, to ensure that more of Europe's financial firepower can be directed towards those companies and sectors that will drive the economy forward. These long-term patient investors are absolutely critical to our success, and we are working to ensure that there is nothing holding them back. But underpinning all of these aspects is our market infrastructure, which is not working effectively and is a drag on our competitiveness. Last December, we put forward the Market Integration and Supervision Package, which is a highly ambitious package and is firmly focused on integration and simplification. It removes obstacles to cross-border provision of services when it comes to trading, post-trading, and asset management. Together, these sectors provide the essential services which enable intermediation between investors and those seeking finance throughout the Union. It also aims to make supervision more efficient by moving it to ESMA for significant market infrastructure and for crypto asset service providers. For those offering services across our union, we need to be able to offer a streamlined supervisory approach. The MISP focuses on integration through structural changes to our financial system. But at its core, it's really about being able to allocate capital throughout the EU with ease. But while our work on capital markets is essential, we should not lose sight of the central role that banks continue to play in Europe's financing ecosystem, and the work that remains to be done to create a more integrated and competitive banking sector. So since the beginning of this mandate, all new and revised initiatives are being examined through a lens of competitiveness and simplification, and the banking sector is no different. Judging by key metrics, the EU banking sector is performing well, and importantly, it is profitable and resilient. That was clearly spelled out in the previous panel. Capital and liquidity buffers are strong, and banks have built resolution buffers and became more resolvable in case of crisis. This is not just truth on paper. Recent crises outside the EU have tested our banks, and they have proved their strength. So what do we mean when we say the sector is not competitive enough? Ultimately, it comes down to scale, to your point. It comes down to scale because it does so in two fronts. Internally, our EU banking market remains too fragmented, limiting the ability to operate and compete seamlessly across borders, which also impacts our external position, as our banks often lack the scale or the actual size needed to compete globally. Scale remains a structural challenge, especially when compared to American banks. This is reflected in lower valuations, but also in higher costs and a weaker global positioning. Europe's key constraint is that the single market remains fragmented across national borders. But this is not to say that reducing fragmentation would mean fewer or only large banks in the EU. We need a diverse range of banks. Small and medium-sized banks provide an important service for many European citizens and businesses, but we do need to see some bigger European banks, a handful to a handful. Let's leave it at some, not too many. But we need to see these bigger European banks that can genuinely compete at the international level in key markets, including investment banking, market-based finance, and digital financial services. And what would a competitive banking sector look like in the EU? In my view, it must be, above all, resilient. But it must also be efficient, innovative, and capable of allocating capital where it is most productive, supporting investment, enabling innovation, and financing the growth of new and expanding firms. It should continue delivering high-quality financial services to households and businesses at low cost. In recent weeks, we have gathered extensive feedback from stakeholders through our consultation on EU bank competitiveness, with way over 200 contributions from public authorities, supervisors, industry participants, and citizens across Europe. This input will inform our forthcoming report on the state of the banking system in the single market. My services are hard at work to get this over the line before the summer. The date is July 15th. We will then prepare for a banking package for the first quarter of 2027. Without preempting the outcome, one conclusion is already clear. We need to be ambitious. To achieve a truly competitive and integrated banking market, including a completed banking union in the EU, just as in our capital markets, we must make it easier for banks to operate across borders. That means reducing unnecessary complexity of our requirements and of the banking framework, as well as addressing fragmentation and enabling a more seamless single market. Maintaining the status quo is not an option if we are serious about funding a competitive EU economy. Because if we want to achieve fundamentally different outcomes, we must take fundamentally different decisions. And this is, to your point, it's not tweaking at the margins. That will not do it. Nothing is off the table, and we need to examine everything, including our microprudential, macroprudential, and resolution requirements, and how they interact with one another before drawing final conclusions. At the same time, internationally agreed standards are less aligned than we would like, with jurisdictions tailoring their implementation of international standards to the local characteristics of their banking sector. We will be equally attentive to the specific features of the European system as we shape our approach, and we will firmly safeguard a level playing field and ensure that EU banks are not placed at a disadvantage. Ladies and gentlemen, competitiveness and stability must go hand in hand. And it is our responsibility to create a more competitive banking landscape without compromising on the resilience of the system that took so long to achieve. The strong interest in financial integration, both from industry and politically, everyone supports the SIU, demonstrates clearly that a more integrated European financial services sector will benefit all participants in the financing ecosystem. Market participants stand to gain from deeper liquidity, greater scale, and more efficient capital allocation. Companies from improved access to diverse and competitive sources of financing, and citizens from broader access to innovative financial services and products at low cost. I would add that politicians also benefit because they would get more votes for having made the right decisions. So the One Europe, One Market roadmap agreed by all EU institutions 2 weeks ago sets the stage to finalize our work in good time. I am looking forward to working with colleagues across the institutions to get the SIU proposals over the line by the end of this year so that we can see the impact of the SIU reflected in strength and integration of the financial system in years to come. Thank you.
Okay, we have 6 minutes and 20 seconds for Q&A.
Right. Okay.
Please, who wants to start? Who wants to break the ice? Well, you actually, I don't know if you remember the question that you got before you took the stage, but does anyone have a question? Philippe? We have people online as well who are sending in questions, and Philippe is
yes, I guess
keeping a track of them.
Excuse me, is one question that wants to have more detail on how the market integration and supervision package actually contributes to market integration. I guess is the voter perspective, how that can, how you can explain that.
Okay. Given that we have less than 5.5 minutes, I'll go for the short
I think you have a
answer.
few more minutes. Yeah.
Okay, so this is about eliminating the barriers. It's about making clear that delivering for Europe is no longer about us competing among ourselves. That's not the game we are playing anymore, or at least it shouldn't be. The game we are playing now is Europe competing with other major economic integrated blocs. And for that, we need to act more as one. So we need to remove the barriers. The market integration and supervision package is about removing the barriers that will allow us to have capital markets which have the scale, the depth, the liquidity that will allow every investor and every business in Europe to have exactly the same opportunities. And especially if they have to go cross-border, that they don't go cross-Atlantic, which is what's happening today. This is particularly important for the scale-ups, that they have the opportunity to grow here. It's essentially the same problem of scale. And there is one fundamental point. There is no such thing as big member states. We're all small. Some know it, some are still struggling with the notion, but we are all small for the scale of the challenges we are facing. And that is basically what the market integration supervision package tries to bring about, is removal of those barriers when it comes to market infrastructure and supervisory architecture of capital markets.
Okay, who's next? Yes, Ignacio.
It's a very nice program. What type of response do you expect from national politicians? And how do you plan to approach the reaction and possibly the opposition of national politicians to this program?
Well, on the market integration and supervision package, I have the support of the European Parliament, or at least so I like to believe, but I think I do. And when it comes to the Council, we are already discussing this actively because we have tabled the proposals in December. And there are some opposing firmly, especially the main issue here is central supervision, is the change in the supervisory architecture, who supervises centrally, what stays at the national level. That's where we have the major political debate, I would say. I think that there is clearly a supporting majority, clearly with a preference for watering down our level of ambition. But we are still discussing, so I'm still hopeful that we can deliver something really meaningful, because again, repeating what I said, this is not achievable with small tweaks and incremental improvements. It's not going to work like that. We don't have the luxury of time anymore, because the gaps we are seeing in terms of our competitiveness, of our productivity, if we wait for too long, the gap will become too wide and we will not be able to recover. So the time is now.
Okay, Ignacio, satisfied? Okay, I thought I see, yeah, there's a hand there, please.
Well, thank you, Commissioner. I couldn't agree more, basically, with everything you said. But if I take on the point that indeed we have to realize we are all small, being small also doesn't allow us as sovereign to issue big. And there comes the question raised by Mario Draghi in his report about creating the deep enough, liquid enough, common European safe asset. There hasn't been, well, there have been quite a few proposals over the years. The most recent one, probably Olivier Blanchard's, about creating a common European safe asset. It's a difficult one, I appreciate, particularly if we try to avoid any risk sharing, which is no-go between small nations. But how do we approach that? How do we move forward to indeed creating large enough, liquid enough, deep enough, safe sovereign asset, which, well, European sovereign asset, which can be the basis of European money markets and, you know, everything related to having a very deep and liquid capital markets as part of the savings and investment union?
Right. Well, the short and easy answer would be that is not in my portfolio. But I will not try to get away with that. I prefer to use the words that Ignacio was using in the previous panel. there are obstacles in our way we should not keep banging our head against, and we probably should go around. I do have in my mission letter EDIS, so I do have one of those big blocks in front of me, which I will have to find a way to go around. The safe asset is important for the SIU, fully agree, but it is not part of the project, and it is something that will have. And I understand the point that it would be a major game changer. There are plenty of game changers. What I fear is that if we continue to go back to topics where clearly there is no political openness to discuss in any way or shape, that will prevent us from doing all the other things. And even if what we are doing already under the SIU is not enough to deliver the ideal scenario, it can make such a big difference that actually can put us at a different standard going forward. So when I hear this, some of the topics which are not solvable at this stage coming back, my only concern is that people will say, without solving that, there's no point in trying to do the rest. And I think there is a very good point in trying to do the rest, and maybe we can still try and get to that at a later stage. But for now, I have already too much on my plate, so I will not be entering into the safe asset debate.
Unless it happened while I was out of the room, I think it's the first time the topic came up the whole day.
Oh, but it comes when I'm.
Yeah, no, I'm sure.
Comes up all the time to me.
Maybe we have time for 2 more questions. Philippe, you have one?
There's one from the online audience on your opinion on the SIU potential of EU Inc. 28th regime. Your expectation, I guess.
EU Inc.
Yeah. Well,
okay.
I think that the proposal now has to be, or the question has to be addressed to the co-legislators, because the proposal has been tabled and adopted by the Commission, the EU Inc. proposal. The idea is to have a common corporate regime for these companies with the status of EU Inc. that would actually facilitate them to be operating in any of the 27 jurisdictions. Now, it really depends on the co-legislators whether they will preserve the ambition of the proposal or if they will water it down. And it is because the Commission has this very, very strong power of tabling proposals. Then it's for the co-legislator to actually decide what hits the ground. It's not for us anymore, even if we help in the process. So the 28th regime proposal, the EU Inc. proposal, has been tabled, has been adopted by the Commission. Now, both Council and Parliament are looking into it to have their positions, and then there will be an engagement in trilogues. I think that on the One Europe, One Market roadmap, the intention is to have this agreed by year end. So we shouldn't have to wait that long to see where it lands, actually. But it's a very good step in the right direction, I would say, to also help reduce the fragmentation, and especially relevant for not for the startups who want to be scale-ups, who want to grow and need to be able to explore other markets across the EU, also having resources in human resources coming from other EU member states. This could help.
I mean, we like it too. We have something in our report on this also. One last one. Yes, I can't see you.
I can stand up. So my name is Julia Simon. I'm from Finance Watch. I have a question about striking the balance between getting to have the big European champions that we need for big things, but also promoting the diversity of the banking landscape and dealing with the smaller banks. So what is your current thinking, let's say, on the measures to strike that balance? Because we know that at the local level, there is little cross-border activities actually, and local economies are mostly served by those small banks who are actually asking for more proportionality towards them, because they are already struggling in the competition with the big ones who use IRB approaches. They are better placed to offer competitive funding. So we probably do not want them to be out of the scene. We want to keep them. At the same time, we want more integration. So how do you see the measures to resolve or strike the balance here? Thank you.
Thank you, Julia. Good to see you. Well, I think that from a regulatory point of view, we should not decide whether banks should be big or small. We should make sure that there are no regulatory impediments for them to reach the size that makes sense for their business model. So if their business model is about being small and that's what makes sense, regulation should not be overburdening them, and that's the proportionality debate. But if they want to really be big, go for a more universal banking, enter into the CEBO, corporate and investment banking space, then regulation should also not stand in the way, if this makes sense from a business case. So our intention is not to in any way have a negative impact on the diversity of the banking sector. It's allowing the banking models to go where they think it makes sense from a business perspective. And that is the proportionality debate. That's what we are assessing, because I think, as was relatively clear from the previous discussion, there are different ways to address that. You can have the same set of rules applied proportionally, like Basel III to the whole banking system, which is the approach we have opted for here in the EU, at least for now. And there is the American approach, where you have a two-tier system. You have Basel III for big banks with the adaptations they are proposing, and then you have the rest out. They both have pros and cons. Both are ways of delivering on proportionality. I would, however, highlight, because of something, or maybe the way you phrased it, because you said, how can they handle when there are other banks who are more competitive and get more competitive funding? Whatever the way, the model that banks choose, they should be competitive, because it's not for the citizens or the companies they serve to pay a higher price because their size does not allow them to be more competitive. I'm sure that's not what you meant, but it's kind of the idea that it brought to mind. Whatever size they choose to have, they must be competitive in the sense that they must be able to offer good services to their clients at a price which is in itself competitive. Because if not, they will be run out of the market by the competition. And competition is a good and healthy thing that we want to preserve. We just don't want that competition to be done through regulatory means, because that's not the role of regulation. Regulation is to frame the activity, make sure everyone complies, financial stability is guaranteed, and then banks within those rules can choose whatever fits best their business model and their own ambitions and their own client base, if I can put it like that.
Commissioner, I built up expectations. I think you exceeded them. Thank you very much.
Thank you very much. Thank you. No, oh, God.
There's one more. This is the, we had promised that we would show some of the findings from the survey that some of you participated in. So just a few closing remarks. So, I mean, first of all, thanks a lot to all of you, both those who are here with us in person and those who joined online. I think your engagement throughout the day has made this event genuinely meaningful, and it's been great to reconnect with some old friends. Allow me, if I may, to highlight 3 key takeaways from the discussions. On CU implementation, I'm going to think about this acronym differently from now on. There is a broad consensus on the urgency of fully and swiftly implementing the SIU and completing the banking union. And I think the direction is clear and the need for decisive action is widely shared. On the topic of retail investor participation, as was underscored in our report and in the one of the Commission, strengthening retail investor engagement, and advancing pension fund development are essential pillars. So this morning's panel, I think, offered rich insights with the call to improve financial literacy, emerging as a particularly strong theme, and it inspired me with an idea for writing something about compound interest on social media this weekend. We were reminded about the importance of compound interest and when we learn it. European banking scale. Banks remain the indispensable bridge between savings and investment. For Europe to compete globally, it must nurture a small number of large, truly cross-border institutions with scale, capacity and ambition to operate as European rather than as national champions. And I think if we were to, what was the word of the day? I think the word of the day would have been scale. Scale in banking, scale in capital markets, and scale in ambition. Now, as I promised, I would like to share some of the results of our poll. You recall that we asked participants to prioritize 4 initiatives within the Savings and Investments Union agenda. So they were strengthening retail investor participation and deepening investment and financing channels, enhancing supervisory efficiency, and supporting a more competitive banking system, and then to identify within each the most important policy measure. So we've got some of the results there on the screen. I mean, I think I only got to very briefly because they are being accumulated real time. But I found this one a bit striking in the sense that there is not really a the previous one, Philippe. I mean, there's not really a consensus there, is there? I mean, it's kind of everything, everything. So, I mean, this is maybe, I don't know if this is an issue in itself, figuring out how to prioritize. So then we can go then, and we just have 4 more slides going for each of those policy domains very, very quickly, and what people thought are the most important. I think we have a bit more clarity within the domains. So here we have citizens, retail savings, and we have RIS, financial literacy, and SIAs. Savings and investment accounts are the clear winner there. And I mean, I don't know, the next 2 are I would say that they're arguably pretty close. Go to the next one. Supplementary pensions. Again, we've got 2 that are completely neck and neck. Pension tracking systems and PEP regulation review, both 44%, and then IORP2 directive review. I don't know whether one might have needed specialized knowledge to, tick the box there. But so anyway, that's where we've got. Then on investment and finance, next one. Did I skip one? Investment and finance should be the next one, no? That's what I have in my... Oh, yeah, okay, it's ordered now differently. Yeah, okay, well, there's a clear winner again. My slides are updating real time. Banking competitiveness measures in pole position on that one. And then finally, on supervision and market integration, I think the message on deposit insurance was heard today during the conference. So I think that is maybe a compliment to the Vice President's speech and the discussion at the beginning of the conference. So I think that's basically all I have to say. And just to say thanks a lot to the speakers for all the effort. We know how much work is involved, the amount of preparation and so on. Without you, the day would not have been the day that it was. So thank you very much, and to the Commissioner.